Something just changed in XRP that matters more than it looks. While most investors are focused on daily price movements, a major shift is unfolding in Washington that could reshape how digital assets are regulated in the United States. And with key negotiations entering a critical stage, markets are paying close attention. In this video, we're breaking down what is happening with the Clarity Act, why lawmakers on both sides are pushing for progress, what it could mean for crypto market structure, and why XRP investors are watching this development so closely. The reason this story matters isn't because of a single bill. It's because regulation has been one of the biggest unanswered questions in crypto for more than a decade. Institutions have waited, companies have hesitated, and investors have spent years trying to determine how digital assets will ultimately fit into the financial system. Now that uncertainty may be starting to narrow. The Clarity Act already passed the House with strong bipartisan support and later advanced through the Senate Banking Committee, moving one step closer to a potential Senate vote. But here's where it gets interesting, ladies and gentlemen, spicy. The debate is no longer about whether crypto needs a regulatory framework. The debate is about what that framework will look like. Stablecoins, DeFi, consumer protections, regulatory jurisdiction. These are the issues being negotiated right now, and the outcome could influence how capital institutions and innovation interact with the crypto market for years to come. And for XRP holders, that's why this story deserves attention. If you want the satellite perspective on XRP and crypto and want to cut through the daily chaos and noise, subscribe to the channel, like, and share. I break it down simple so you can see what actually matters in the markets. Let's talk about where things stand. In July 2025, the House passed the Digital Asset Market Clarity Act with a bipartisan vote of 294 to 134. That margin was significant, not because everyone agreed, but because support came from both sides of the aisle. If you fast forward to May 2026, the Senate Banking Committee advanced the bill by a vote of 15 to 9, again with bipartisan support. That vote moved the legislation one step closer to a full Senate vote. But the process is not finished. Several major issues continue to be negotiated. Stablecoin rewards, DeFi provisions, regulatory jurisdictions, consumer protection requirements. These are very important. And the political reality of gathering enough support to move the legislation forward. See, the outcome remains uncertain, yet momentum has clearly increased. And markets tend to pay attention whenever regulatory uncertainty begins to fade. To understand, ladies and gentlemen, why this truly matters, I want to consider a real historical example. In 1825, the Erie Canal opened in the United States of America. At first glance, it was just infrastructure, a waterway, a transportation project. But its true significance wasn't the canal itself, ladies and gentlemen. It was the economic framework it created. See, suddenly goods could move faster. Costs fell, trade expanded. Entire regions experienced growth. The canal did not create commerce, ladies and gentlemen. It enabled it. You see, crypto regulation may function similarly. The Clarity Act doesn't create Bitcoin or blockchain technology. Again, it doesn't create XRP. It doesn't create Bitcoin. Instead, supporters argue that it creates the framework that allows capital, businesses, and institutions to operate with greater certainty. And throughout history, frameworks often matter more than headlines. See, the battle over stablecoins is happening right now, and it's one of the biggest debates involves this. See, specifically, whether issues should be allowed to provide yield-like rewards. Traditional banks have expressed concern. Why? Because if consumers can earn attractive rewards through stablecoin ecosystems, deposits could potentially migrate away from banks. Crypto advocates argue the opposite. They claim programmable money should be allowed to innovate. The compromise currently under discussion appears to prohibit passive interest merely for holding stablecoins while allowing certain activity-based rewards. The distinction sounds technical, but it could become one of the most important financial plays and policy decisions of the decade. Because stablecoins increasingly sit at the intersection of banking payments, commerce, and digital assets. And whoever controls that intersection could influence the next generation of financial infrastructure. So the SEC versus CFTC question. Another major issue is regulatory jurisdiction. For years, the SEC and CFTC have often been viewed as competing authorities in crypto oversight. Many industry participants argue that uncertainty around jurisdiction created confusion and increased legal risk. The Clarity Act attempts to establish clearer boundaries between agencies. Supporters believe this could reduce regulatory ambiguity. Critics argue additional safeguards are still needed. Either way, the debate highlights something important. Markets do not respond to profits. They respond to predictability. Institutions often prefer clear rules over perfect rules because clear rules allow planning, and planning drives investment. But here is where it gets interesting. This isn't just about regulators. It's about capital allocation. Think about medieval trade routes. Merchants traveling across Europe often faced dozens of different toll systems, currencies, and local regulations. Every border created friction. Every uncertainty created risk. Crypto today faces something similar. Different interpretations, different agencies, different legal assumptions. See, the Clarity Act attempts to create something closer to a unified roadway. Not a perfect one, but a more predictable one. And historically, markets tend to expand when friction declines. So why XRP investors are watching? Let's address XRP now. Why is the XRP community paying such close attention? Because XRP, the anointed one, has spent years sitting near the center of regulatory discussions. Many investors believe regulatory clarity could improve institutional confidence surrounding the asset. Whether that ultimately happens remains uncertain, but perception matters. Markets often react not only to fundamentals, they react to changing expectations. See, supporters of XRP argue that clearer digital asset clarifications and classifications could strengthen the investment case for institutions considering exposure. Skeptics argue adoption ultimately depends on utility and demand. See, both perspectives are worth considering. The key point is this: prices reacting, systems evolving, and those are not always the same thing. I want to talk about the Glass-Steagall era. See, here's another real historical example. Following the Great Depression, policymakers introduced major financial reforms. Among them was the Glass-Steagall framework. Regardless of whether people agreed with every provision, one reality emerged. The financial system received clearer operating boundaries. Investors could better understand the rules of the game. Confidence gradually returned. The lesson isn't that crypto regulation will create identical outcomes. It won't. The lesson is that markets frequently reward certainty, even when participants disagree with the exact rules. See, certainty reduces hesitation, and hesitation is often the enemy of capital formation. So the political calculus, politics also play a major role. Supporters argue failure to address crypto policy risks pushing innovation offshore. That's really important, ladies and gentlemen, to pay attention to, because right now, I always go over the unit bricks against the east and west side of the tranches. They're not taking prisoners. They're going forward. So this has to get done, in our opinion, and we're in the camp that this gets done, in our opinion. See, opponents worry about consumer protection, anti-money laundering, provisions, potential unintended consequences. See, both sides understand something very important. Digital assets are no longer a niche topic. Millions of Americans own crypto. Institutions increasingly participate, and elections tend to magnify issues that affect large voting blocks. This is one reason crypto legislation has become a bipartisan conversation rather than a purely partisan one. Now, this is what most people miss. Washington moves slowly until it suddenly moves very quickly. That's why I always tell you that watching certain things is like watching paint dry on the wall. It's very, very boring. You got to pay attention to what's quiet always. I hammer this in every video and every phone call that I have. I want you to imagine the early railroad era, okay? Before national standards, rail systems often used different track gauges. Trains couldn't easily move between networks. Growth was fragmented. Then standardization arrived, and the network effect exploded. Okay, let that sink in for a second. Crypto regulation may follow a similar pattern. The technology already exists. The question is whether the rules eventually allow broader integration. Again, this is an analogy. It's not a prediction. It's not financial advice, ladies and gentlemen. But throughout history, standards often unlock scale again. So what happens if this bill passes, you're probably asking? If the legislation ultimately becomes law, several developments could follow. Institutions may gain greater confidence. Compliance departments may find it easier to evaluate digital asset opportunities. Capital allocation decisions could accelerate. New products could emerge. More builders could choose to remain in the United States. Notice something important here, ladies and gentlemen. None of these outcomes guarantee higher prices. They don't. But they represent structural developments. And the structural developments often matter more than short-term market moves. That's why I always say short-term noise, long-term structure. That's the distinction investors should focus on. So what happens if it doesn't? This is another important question. Let's talk about the opposite scenario. It deserves attention too, always, right? Coin has two sides, heads and tails. Legislation could stall. Negotiations could take longer. Political priorities could shift. Additional amendments could emerge. Markets sometimes pricing expectations before outcomes arrive. And when expectations become too optimistic, disappointment can create volatility. That's why disciplined investors focus on probabilities rather than certainties. The future is never guaranteed, ladies and gentlemen. I always tell you, the only thing that's guaranteed is death and taxes, even when momentum appears strong, okay? So let's go over the biggest story here for a second. See, the biggest story isn't whether XRP rises tomorrow or next week or next month. No. The biggest story is that digital assets are gradually moving from an experimental industry towards a regulated financial sector. That transition has been occurring for years, okay? The Clarity Act is simply one chapter in the larger evolution. And whether you're bullish or bearish on crypto, the evolution is difficult to ignore because regulation isn't replacing the industry, ladies and gentlemen. It's increasingly becoming part of the industry. So I want to recap all this. The Clarity Act passed the House. It advanced through the Senate Banking Committee. Negotiations continue around stablecoins, DeFi, and regulatory authority. Supporters see a path towards greater certainty. Critics continue pushing for additional safeguards. And investors across the crypto market are watching closely. So for XRP holders, the legislation represents a potential structural catalyst, not a guaranteed price catalyst, a structural catalyst. And that's an important difference because prices reacting, systems evolving. I always tell you to pay attention to what's quiet, ladies and gentlemen, because in my career, what I was taught on the floor of the New York Mercantile Exchange starting at 15 years old, all of finance is quiet except for the people prospering from it. No one's ever going to tell you what positions they have. They're not going to tell you what they're looking for. And I remember learning from people on the floor that all they did was look at a card with no computer screens in front of them. So you had to do all your charting work at night the day before. Imagine people doing that today. I still do. So I want to hear, ladies and gentlemen, what do you think in the comment section? Will the Clarity Act become law? Could regulatory clarity accelerate institutional adoption? And what impact, if any, do you think it could have on XRP? I want to hear your thoughts in the comments below. Because does this change the narrative of what's happening? I always go over narratives, in my opinion. But as always, if you enjoyed this deep dive, make sure to like the video, subscribe to the channel, turn on all your notifications. Don't miss any of our future updates on crypto, macroeconomics, my rants, regulation, digital asset markets. Share this video on this channel with someone who you feel needs to get up to speed with what's actually happening in the markets. Thank you for watching. And remember, ladies and gentlemen, short-term noise, long-term structure. Pay attention to what's quiet. I'll see you in the next one. Hope everyone's having a great day. Happy Saturday. I want to welcome all the new members of our Patreon, the Crypto Public Desk Monthly, all the new members of the membership channel. A lot to go over today, real fast. If you're looking to learn how to trade, if you want to learn how to invest, and you want to learn how to take advantage of everything I go over, do come and join the Crypto Public Desk Monthly. Here, we identify what we're looking at. Inside there, we're taking advantage and holding and mentoring everybody. One good tip from the pit can easily pay for your entire year subscription. So if you're looking for deeper macro research and you want to learn how to take advantage of this, come and join almost 600 active traders and investors right now inside the Crypto Public Desk Monthly and the Patreon. We're taking advantage of stocks, metals, crypto, futures, everything, because this one time in history, I can't wait to look back and see how they write about this in the history books. But right now, I want to go over something more important. See, I think gold investors are looking in the wrong direction, personally. This is what I think. See, everyone's watching what investors and American investors are doing right now, most importantly. And now, as far as I'm concerned, that's probably the biggest mistake in the gold market right now. You got people changing their forecast. Goldman Sachs lowered their forecast. So over the past several weeks, we've seen continued outflow from some of the world's largest gold ETFs. Again, so most of these funds are domiciled in the United States. And if you only looked at those numbers, you're probably concluding that the enthusiasm for gold is fading. And after all, see, none of this is financial advice, just my own opinion and retains any capacity. Gold recently suffered a sharp pullback. And I've been telling everyone here that we were short-term bearish and long-term bullish. You took any of that and you wrote that down, I salute you. See, the metal was attempting to establish a base above the 4,000 level before headlines surrounding an Iran peace agreement triggered a wave of selling pressure. So gold dropped hard, sentiment weakened, and many participants immediately began asking whether the bull market had finally run its course. But here's the problem. The people asking the question are looking at the wrong data. Because while Washington investors are pulling money out of gold ETFs, something entirely different is happening elsewhere. And if history teaches us anything, it's that physical gold markets often tell the real story long before financial markets catch on. So if you look at the numbers, right, and I always say you got to go and look at numbers. Numbers are very important. Switzerland remains the world's most important gold refinery and export hub. It's effectively the central artery of the global physical bullion market. When large amounts of gold begin flowing from Switzerland into specific regions, investors should pay attention. I can't believe I give this away for free. If you just take anything from this video, that one factoid, you good to go with that. That's so important. That was one of the first things I was taught on the floor of the New York Mercantile Exchange in the gold pit. Never forget. That is so important. But right now, two destinations stand out. Hong Kong and India. Write them down too. Because both have emerged as a major importers of Swiss gold and are currently absorbing substantial quantities of physical metal deposits despite the recent weakness in prices. Okay? Think about what that really means. Okay? Gold falls sharply. Western investors sell, yet buyers in Asia step in and increase purchases. This is not the behavior you typically see at the beginning of a bear market. It is often the behavior you see when long-term buyers view weakness as an opportunity rather than a warning. And the ETF data supports the same conclusion. Gold ETF holdings in the United States have been declining. European ETF holdings have largely stabilized. But Asian gold ETFs continue to accumulate metal at a remarkable pace. And now some analysts dismiss this because Asian ETF markets are smaller than those in North America and Europe. But that's exactly why this trend is so interesting. The ETF figures are likely only revealing a fraction of total demand. And unlike many Western investors who pay and gain exposure through financial products, Asian buyers have long-standing preferences for physical ownership. They like bars, coins, jewelry, direct bullion holdings. The ETF accumulation is very visible with them. The physical accumulation is much harder to measure. And yet Switzerland's export data suggests both are occurring simultaneously. That combination matters because markets are ultimately driven by supply and demand, not narratives, not headlines, not social media opinions. Like I always tell you, I don't tweet. I'm not a bird. I don't do that. Actual buying, actual selling, actual flows. Now let's compare this to another market attracting investor attention, Bitcoin. Love it or hate it, Bitcoin ETF outflows have begun to ease after recent weaknesses. That suggests some capital may once again be rotating towards digital assets. Many commentators immediately interpret this as a threat to gold. The old argument reappears. Bitcoin versus gold, digital gold versus physical gold, blah, 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 blah. One must win and the other must lose, blah, 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 blah. But markets rarely operate that way, ladies and gentlemen. See, institutional portfolios today are vastly larger than they were a decade ago. And this is important. So central bank balance sheets continue to expand. Government debt continues to rise. Geopolitical uncertainty globally remains elevated. So in this environment, multiple stores of value can attract capital simultaneously. The more important question isn't whether Bitcoin is receiving inflows. The more important question is whether physical gold demand remains strong. And right now, the answer appears to be yes, very much so. What fascinates me most is not that Asian investors are buying gold. It's that they continue to buy despite recent weakness prices. That's a crucial crucial distinction. Anyone can chase momentum and get caught up like sushi. Anyone can buy when prices are rising. But when investors continue accumulating during corrections, they reveal something much more valuable: conviction. And conviction is often one of the early signals of underlying market strength. That's why I always tell you, you got to have that Gucci conviction, that Gucci clarity. This is where you don't get caught up like sushi. This is why we take this long, frosty march up this frosty mountain with our frosty beverage. These things matter so much. And if you're still here in the video, why haven't you subscribed and liked this video yet? Because this is why everyone is in the Crypto Republic, for this part. I spend so much time talking to family offices and people that retain us to go over this. Conviction, conviction, conviction. It's all that matters, ladies and gentlemen, that Gucci clarity, that Gucci conviction. See, I've seen this pattern before throughout commodity cycles. The headlines prove negative and they become negative. Short-term traders exit, they get cut up like sushi, momentum weakens. Yet strategic buyers quietly continue accumulating. Why do you think I always tell you pay attention to what's quiet? Months later, the broader market suddenly realizes demand never disappeared. By then, the opportunity has often already passed, unfortunately. So while investors, many of them remain focused on ETF outflows in New York and London, I believe the most important question is what's happening in Mumbai, Hong Kong, Shanghai, and of course the broader Asian market. One thing I was told when I first started working over in Asia, everything over in Asia has a chance to turn to gold, because that's where the strongest evidence of demand currently resides. And right now that demand appears remarkably resilient, perhaps more resilient in my opinion than the market appreciates. So if we take that to be true, then the recent weakness in gold may ultimately be remembered not as the beginning of a larger decline, but as a pause inside a much larger trend. Ladies and gentlemen, that's why I say pay attention to what's quiet. That's why I tell you traders have to make their weekly, their monthly, their quarterly numbers. We pay attention to what they're doing and why, what they're legally forced to publish of holdings. See, the information to prosper is there if you know where to look. Ladies and gentlemen, if you want to learn how to trade and how to invest, right? If you feel you have to, and you want to see to take advantage of everything I'm going over, come and join the Crypto Republic this monthly. Okay? One tip can pay for your entire year subscription. Come and join over 600 active traders and investors. We're going to be capping the numbers soon because it's just too many people in there. And there's only so much of us to go around, unfortunately, right? I love helping everyone, but I give away so much stuff for free. So much for free. If you're writing this down, and if you're new here, welcome to the Crypto Republic. Welcome to the Wolf Pack. We are the Wolf Pack because the wolf's not the mightiest animal in the jungle, but you don't see it doing tricks in the circus. Why I say we're financial mercenaries is because you take all of this knowledge, everything that we're giving away here for free, right? If you're writing this down, you're getting plays by plays of what we do for people that retain us in any capacity. See, we don't work for retail people. We don't. Been doing this game since I'm 15 years old, right? And I finally got to the point in my career that we had to give back. And that was the biggest thing that the floor traders from very powerful family offices and families and locals taught me at the beginning of my career. At some point, you have to give back in this game. You got to pay it forward and you got to pay it backwards. You just have to. Come and join if you want to learn how to do this, because there's always market noise somewhere. The TV doesn't really tell you the truth. See, to me, truth is treason in the empire of lies. So if you look at what's happening right now, what do you think is really happening in the markets? I told you, I basically, if you go back and look through the videos, right? I'm not the greatest person making YouTube videos. I'm not. I edit the videos. You know, we make them when we have time, right? But the outpouring in comments inside of the Patreon, in the private chats, unbelievable. I love everybody. You know, we really, really do. But you got to understand something. People expect instant gratification in markets. It's never going to be that, ladies and gentlemen. It's just not that. If you think you can outlast the market, you will be cut up like sushi. I'm sorry. You're going to get cut up like sushi. I can't tell you how many concessions that we have developed. And when we started working on the concessions, the recoverable metals inside of the ground, some of them we were upside down. We're underwater. I remember that, because we focus mostly on platinum and palladium. That was very big with a lot of things. See, we started doing solvent extraction, electrowining in places around the world long before it really became industry standard. And people laughed at us. I mean, I remember going on roadshows saying, look, here, we're going to take rock. I'm going to put it in a autoclave, which is a fancy word for a dishwasher. We're going to leach it, spray with acid, leach out all the precious metals, separate with a atomic magnet. People thought we were insane. But the few people that stopped to listen changed their entire existence. And in certain areas, you changed everything. You see this time and time again. If you look at how Aflac, that company got huge, they went and did road shows. They stopped in certain places around farming areas. Some people invested. They did very, very well. Others laughed at them. Look at what it is now. So if you think that you're going to outlast the market, you have this game all wrong. See, the market's, we're here for the market. The market's not here for us, ladies and gentlemen. We're here for it. You have to respect it. Your position size has to be small enough to be added to, cut up, carried. See, this game is not, I wager more, I get richer quicker. Wrong. Do not pass, go collect $200. That's how you get cut up like sushi. The game is not like that. So as these big bangs change everything, like when I told you that we went long Bitcoin, and then I told you we had sold our position. Even if you write down, and this is not financial advice, just the things that when I give it away that I'm doing for myself personally, and anyone who obtains our organization any capacity, even here free, if you're long enough viewers of the channel and you get to the rant part, if you write these things down and you're actually following what we're saying in your trading journal, you should have a trading journal. You should be writing things down. You should have an Excel sheet. You should be so organized how you're doing this, because this is the money that you work hard for. See, most people sit here. You work hard, right? How many people here are working a second job to be able to buy crypto? I'd like to know. Okay. Think about it. You work real hard for your money. So how come you're not making that money work real hard for you? How come you don't respect how you traded or how you invested? How come you don't have a plan? This is not a casino. It's not. If you want better odds, go play roulette. I love you all, ladies and gentlemen. Have a blessed weekend. We're going to be traveling on Sunday for business. We'll have content for everybody. I got to go visit some family offices. We're being referred to more people. See, with our organization, we're referred to by word of mouth. We're at the point now where we don't really take more clientele any longer. We can't service everyone. I know that's a good problem to have, right? But when you work for certain types of people and family and organizations, they don't like to share. I don't blame them. But again, whether I'm in the camp that this gets passed, again, it doesn't matter. Because if you have those skin in the game, it doesn't matter whether it does or doesn't. You understand me? The world's changing. It's really changing. It is. And it's whether or not you want to have a stake in that change. But as always, ladies and gentlemen, this content is not financial advice. This information is for educational, entertainment purposes only. Never invest based solely on a YouTube video. Always consult a licensed professional. Again, this is just my own opinion and retainers any capacity. The biggest lesson I learned, and I learn this again every day. When you look at a financial instrument, doesn't matter if it's futures, stocks, bonds, FX, physical, doesn't matter what it is. The prices will fluctuate. That's always going to fluctuate up and down. But the intrinsic value of that financial instrument doesn't change. The utility of it doesn't change. If you write what I just said down and you can grasp that, you are so far ahead of so many people when you look at price actions and the actual utilization of that instrument, you're further ahead. You won't be as emotional. You'll understand that its utility is being consumed. I'm not a crypto influencer. I can't believe how fast our channel has grown in the community. But you know what, ladies and gentlemen? look in the mirror and understand why you're in this market. What is it? Write it down. When you write these things, you have a more personal attachment to what you're doing. A strategy, plan. I love you all. I'll see you on the front lines. None of this is financial advice. Remember, don't get caught up like sushi. Don't FOMO this. Gucci conviction, Gucci clarity all the way. This frosty mountain that we're walking up is nasty, ladies and gentlemen. The incline's going to get nasty. That's why we're drinking our frosty beverage. But I promise, for me, when we get to the top of this view, it is a beautiful, beautiful thing to look at when we get to the top, to look at this beautiful view. But nothing in life is guaranteed except for debt and taxes. That's why they say in life, it's not the destination, it's the journey. Now, I'm happy to share some of this journey with all of you. I love you all. Stay Gucci.